Welcome to the Wealth Studying Podcast. This is episode 472. Today is May 22nd, 2025. I'm your host, John Pagliano. I'm also the founder and money manager at investablewealth.com. Well, today I want to reiterate how the economy is in much better shape than the negative media narrative. I'm going to illustrate that point by discussing the two best, highest performing sectors of the S&P 500, and I'm going to make the argument that what I've been talking about for a long time and effectively what I wrote about in my book almost a decade ago is that the long-term trend favoring the industrial technology base of the United States is alive and well. Before I get to that, I just want to take a quick diversion. And speaking of quick diversions, I was watching a documentary on the artist formerly known as Prince, and it made me remember a lyrics line that I had forgotten about. And so maybe in the future, instead of saying that I'm digressing, I might just say, hey, I was dreaming when I wrote this. Forgive me if it goes astray. In any case, before I get into the two best performing sectors in the S&P 500, I just want to go through the fear-mongering du jour. You've probably seen that Moody's downgraded U.S. debt. It's no longer AAA. Well, that shouldn't be a surprise to anyone. S&P Global, as I previously mentioned, had downgraded U.S. debt like 14 years ago. I'm not worried about U.S. debt because I don't invest in it. If you own appreciating assets, then it's irrelevant what currency you price them in. But specific to the debt, the corollary fear-mongering story along with that is that, oh my goodness, the 20-year bond auction was worse than expected. They didn't get as many buyers as they wanted to for the 20-year Treasury that I think it auctioned on Tuesday. Well, you know what? So what? Let me tell you something about the 20-year bond. The demand for it has generally been so weak and unpredictable that in 1986, which is probably before most of you were born, the U.S. actually discontinued the issuance of 20-year bonds. It wasn't until the pandemic when the government was printing money like crazy and they were looking for every available nickel and dime that they could milk out of the system to generate revenue that they reinstituted the 20-year bond. Again, most of you listening, for your entire adult life, a 20-year bond didn't even exist. So who cares if there was a weaker demand for it this week than in the previous month? Who cares? It's irrelevant. Keep in mind, and if you're a long-term listener to the podcast, you know this, but I'm preaching to the choir here. The media is not there to inform you. They're there to manipulate you. And ask yourself that rhetorical question. Why do they want you to think the economy is so bad? Because it isn't. And let me tell you why. Just look at the S&P 500. The two best performing sectors of the S&P 500, and if you don't know, there are 11 sectors within the S&P 500. Now, these are somewhat arbitrary and have more of a historical background, and so I don't get totally wrapped up in the delineation of where a stock goes in a particular sector because it's not as straightforward as they'd like you to believe. For example, how do you categorize Amazon? Is Amazon a retailer, or are they a technology company because the vast amount of their growth doesn't come from what they sell you on Amazon, but it's from their Amazon Web Services? Same thing with Google. Now, is Google a technology company or are they just an advertising company? So there's a lot of nuances as to how sectors are determined, but here's the bottom line. Do you know what the two best performing sectors are year to date? Well, the first one is utilities. Yeah, common, old, boring utilities. And again, if you're a long-term listener to the podcast, that shouldn't surprise you. You know that I took a very overweight position in utilities. It's panned out very well. In fact, so well that I had planned on selling it by this point and reinvesting those profits in something else, but utilities have continued to hold up. And I do at some point, probably in the not too distant future, do plan to reduce my utilities holding. Now, I'm not going out and selling everything. It's just that I am significantly overweight in utilities. And so I want to par that back to a more equal weight and take the money that I raise from that and deploy it somewhere else in the stock market. We'll talk about that in future episodes. But look at utilities. Why are they the best performing sector year to date? And they're up over 7% year to date, while the overall S&P 500, as I record this, is down, a little more than 50 basis points for the year. So why are utilities so significantly outperforming the S&P 500? Well, if you're a naysayer, you're saying that, people are just rushing into utilities because the economy is so bad that they know that utilities are defensive in nature. Well, yeah, you could say that. But look at the other two categories, which are considered defensive in nature and where you would want to put your money if you were worried about a recession or a declining economy and you wanted to ride it out in the stock market. Where would you invest as a defensive sector? That would be consumer staples, things like toilet paper and peanut butter and jelly. Or you would also invest in healthcare. And where are those two defensive sectors? Well, yeah, consumer staples are up, but they're up less than 4% year to date. And so utilities on a comparative basis are up almost twice as much. And what about healthcare? Right? Again, healthcare is almost always considered a safe haven sector. Well, healthcare is down over 4% year to date. So the fact that utilities are doing so well is not just because they're a safe haven, dividend type paying sector of the stock market. I mean, that is a part of it, I'll give you that, but it's also because of growth. I'll get to that in a second. But think of this, because I want to give you Negative Nelly's another argument about why utilities shouldn't be performing well. One of the things that the stock market doesn't like right now is that long-term interest rates are going up. And that actually works against owning utilities. Utility companies are notorious for having to borrow a lot of money because they have so much infrastructure. So just like owning a home or taking out a mortgage, when interest rates go up, it generally has a negative impact on utility company profits. Also, from a safe haven status, the higher that interest rates are, the less attractive the dividend that utility companies pay out is. Okay, so higher interest rates should actually be a negative for utilities, and yet they're the number one best performing of the 11 sectors in the S&P 500. Why is that? Well, again, it supports the long-term continuous trend of United States resilient and growing and expanding industrial technology sector. Utility companies are booming right now because of the demand for energy now and in the future. Energy growth, specifically electrical energy growth, has pretty much been stagnant for the last 40 years as the United States has deindustrialized. Well, now and in the future, with more onshoring and more investment in the United States manufacturing base, and with the growing need for power to supply data centers for artificial intelligence, we're looking at electricity demands of 2 to 3 times what had just been projected, 3 years ago. So the utility sector is acting now as both a stable, safe haven type investment and also offering the potential of a growth sector. It's the best of both worlds. But you know what's right behind them? The other sector, which again is head and shoulders above all the other sectors of the economy? It's the industrials. Again, this is evidence of the current and future growth of the United States industrial technical base growing and offering a lot of opportunity and profits. Now, industrials, there's a lot of contradiction and nuance as to actually what gets categorized as an industrial stock. For example, Uber, the ride-sharing company Uber, they're considered an industrial stock. Personally, I wouldn't put them there. But overall, these are names that you would generally consider boring, dull, old 20th century technology. But they're not. They're growing and dynamic, and whether it's something like Union Pacific Railroad or Boeing or Caterpillar or one of the aerospace defense contractors like Raytheon, there's a huge amount of growth and opportunity within the industrial sector, and that's why it makes up, along with technology and utilities, an overweight position in my portfolio. And in fact, as I start to diversify out of some of my overweight position in utilities, you're going to see me stock up on not only more technology companies, but also more industrial companies because I think they bridge the gap, and that's going to be where the largest amount of growth and expansion is over the next decade or more. I just want to wrap up today's episode by again encouraging you to ignore the headlines. It doesn't matter what babble comes out of the nation's capital, whether it's red team or blue team. It's all propaganda. What you want to pay attention to is where the economy is actually growing and expanding. And as for me and my money, that's where I want to be invested. Well, hey, until next time, as always, this is John Pugliano wishing you the very best returns.